Anyone who's 35 years old or younger has probably never felt pain in a bear market. That would have been in 2007, the last time we had real pain, when the S&P 500 fell more than 50% over a 1.3-year time frame. So when we talk about stocks like C3 falling, this is a growth stock. And now that we're in a bear market, we can expect growth stocks to fall more than usual. The concern lies in revenue growth stalling. So what happened with C3 is they recently revised their guidance from, you can read the numbers here, but it translates to a 22 to 25% revenue growth for fiscal 2023, and they revised that down to 1% to 7% revenue growth, with fiscal 2024, so that would be next year, seeing growth resume at 30%. So why did guidance fall? Well, the reason given by the company was that they switched to a consumption-based pricing model, something that had been in the works for several years. And what it leads to are lower barriers to entry and a shortened sales cycle. So in the earnings call, they talk a lot about how the sales cycle is increasing. We've seen that with other firms as well. So when you look at popular SaaS companies like Snowflake or MongoDB, they have business models that are pay as you go. That makes it very easy for customers to start using a product. There's less upfront commitment as opposed to contract-based pricing, which is what C3 uses. So the C3 sales cycle, it includes lengthy negotiations where they're working out a 3-month contract and look at all the different fees that they have to include in there, and it takes a lot of time. Moreover, that sort of contract requires a very big commitment ranging from $1 million to $35 million or more. Well, when there's a bear market and purse strings tighten, that sort of a sale will require board approval, and think about how long that's going to take. So the change in their business model resulted in revenues declining temporarily. This chart is a great way to describe how this works. You can see the orange line is the subscription revenue model and how that's growing over time. And when they switch to consumption, you can see how that declines over the first year or so. And then after 2 years, it starts increasing growth over the subscription model. So now when they approach clients, they start with a 6-month pilot project, almost similar to what Palantir is doing. And then they move to this ongoing pricing, which is very simply a certain number of pennies per CPU hour. So that was the impact that the revenue impact that you saw, that was a result of that business model change, but there may be more to it than that. So in the earnings call, they talked about how they plan to achieve profitability by 2024 with $700 million to spare. So that's great to hear. And they revamped their sales force. They made it a point to talk about all these rock stars they hired, 51 of them. But there was no mention made in the call or the previous call about a short report that came out that we had completely missed. So the last time we covered C3 was in this piece, and we talked about why we weren't worried. And in that piece, we specifically said it wasn't until halfway through this piece that we realized C3 hadn't filed their 10K yet. Well, we went and continued writing that anyway. And we had said, we can't tell you if their customer concentration risk is decreasing over time as we expect it to. And we said we'd follow up. We actually didn't follow up on that. Well, we looked at the 10K, and that contained some information that we would have come across were we to have looked at that via our standard practice. And that was information on a class action lawsuit filed by an investor that led us to discover a short report that was published about C3. Now, you need to take these you need to take them with a grain of salt, because they have a vested interest in making sure the share price craters, and their target was actually spot on when this report came out versus where the share price is now. And when you look at their points of contention, there are quite a few. The more legitimate ones would be, you see here where they talk about C3's positioning and what they believe is the reality, and you have alliances and partnerships. They talk about Baker Hughes and significant sales challenges. That's a concern. Whereas the company fudging the size of the total addressable market, well, everybody does that. It's an estimate. So if they change their estimate, big deal. So you need to really go through and selectively pick out the things that are worth paying attention to, one of those being durability. This is a big concern. They say Spruce Point believes C3 will come under scrutiny as a money-losing company with good but complex and difficult to sell technology. That's kind of a concern. So here you can see where they broke out in that short report the agreements with Baker Hughes that have been changing over time, being revised to be less and less revenue that they expect. And Baker Hughes happens to be their biggest customer. So they represent customer concentration risk that we pointed out before. That was the concern there. And I think the last quarter, they were somewhere around 25% of revenues. But if they can't sell the solution, that's a problem. So when we look at the bulls versus the bears on this recent guidance change, you can point to, well, maybe it wasn't just the subscription model, though that will certainly help shorten the sales cycle and get signatures quicker. But you read through that short report, you should, if you're an investor in a firm and there's a short report, you read it. The revised guidance of single-digit growth, is that solely because of the subscription model? Maybe not, and that's what the bears would say. And this class action lawsuit, again, you do see a fair number of lawsuits like that. It's really difficult to say whether or not, at least from our perspective, there's something to be concerned with. C3 says, well, at this point in time, we don't believe it will have any impact. So, they know very little until they start going down the legal path. And then the bulls will point to the fact that they did revamp their sales team. They have solved or potentially will solve some of the problems they're encountering with the solution being difficult to sell. They would have likely set themselves up to beat their own estimates once they get the bad news out of the way. And of course, one of the main reasons that we look favorably upon C3 is that Mr. Siebel, pictured here, is a tenured executive who sold his last company and has a lot of experience in what he does as an entrepreneur and as a successful businessman. And the talent that they hire is exceptional. So at least according to what our research shows, they're very, very, very selective about who they hire. Well, if they're hiring the best talent, then they should be able to overcome obstacles. So just to conclude, is this a business model change, or did they develop a solution that's looking for a problem that now they can't sell? Well, we're told, the Shell example, that it creates billions of dollars in economic value. That hopefully is a good selling point in the same way that UiPath is able to sell. By the way, they had a recent drop in their revenue guidance because it overall across all the firms we look at, things are becoming more difficult. Sales cycles are increasing. Pipelines are being extended out. So way we look at C3, this is a possible crossroads, and we wouldn't add shares. We already have maxed our position, but we wouldn't add shares until that growth starts to resume, because they can either go one of two ways. Can either do as they said and the growth resumes and it spikes, or they have built something that's very difficult to sell that customers don't want to buy, and they're just going to stagnate. So survivability is assured. They have plenty of cash. They're not going to go bust. That's the one thing a company needs to do is survive. But there's an opportunity cost to hold the company that you need to consider. So please put your comments in the comment section. Make sure to subscribe to our channel. Click the thumbs up, please. And thanks for taking the time to watch this video today.